All right, let's get right into it. Every quarter, the entire investment world basically stops what it's doing to see what the legend, the Oracle of Omaha himself, has been up to. Today, we're decoding Warren Buffett's latest moves. So the big question on everyone's mind is, in a market this complicated and weird, where's a guy like Warren Buffett putting his money? Well, we're about to get a rare peek inside his playbook. And trust me, one move in particular tells you everything you need to know. Now, how do we know all this? It's all thanks to a little document called a 13F filing. The easiest way to think about it is like a mandatory shopping list. Big-time investors have to file it every quarter, showing us exactly what stocks they've been buying and what they've been selling. Okay, so before we get to what's new, we've got to look at what's out. To understand where the money is going, you first have to see where it's coming from. So let's start with what Berkshire was selling. The biggest exit this quarter? A complete sale of their entire position in T-Mobile. Yeah, the whole thing. That's a huge move, and it's a pretty clear signal they think there are better places for that cash.
And we're not talking about a small position either. This was a $1 billion stake. When they sell the entire thing, it shows some real conviction that it was just time to get out.
But T-Mobile wasn't the only stock getting a haircut. They also trimmed a few other big names. Bank of America, Charter Communications, Davita, and get this, they even sold a tiny piece of their biggest holding by a country mile, Apple. Now that's likely just skimming some profits to put to work somewhere else. So, with more than $1 billion in fresh cash just from that T-Mobile sale, you have to ask, where did Buffett and his team decide to put it? Let's get to the good stuff, the new bets. This quarter, we saw a few new, smaller positions pop up. Berkshire started buying into a pretty diverse group. A steel company, Nucor, a home builder, D.R. Horton, a security company, Allegion, and even Lamar Advertising. But honestly, all of these were just the opening act for one massive, totally surprising new investment. And that brings us to the main event of this whole thing, what I'm calling the UnitedHealth puzzle. This is a move that, on the surface, looks just incredibly risky. It's a multi-billion-dollar bet on a company that, frankly, looks like it's in total crisis mode. And here it is. Berkshire Hathaway bought over 5 million shares of the health insurance giant UnitedHealth Group. The total investment? A cool $1.6 billion. And this is where the story gets really wild. I mean, why would you make a huge bet like that right now? Let's just run down the list. UnitedHealth is facing a Department of Justice investigation. Their CEO just quit in the middle of all this chaos. They missed earnings for the first time in a decade, and oh yeah, they just had a massive cyber attack. For most people, this is a 5-alarm fire you run away from, not toward. So that's the billion-dollar question, isn't it? Why would the smartest investor in the room pour a fortune into a company that seems to be drowning in bad news? Well, the answer is that this isn't weird at all. In fact, this is the most Buffett-like move imaginable. This is a classic, textbook Warren Buffett play, finding a fantastic opportunity buried under a mountain of pessimism. It all goes back to his most famous quote, the one you've heard 1,000 times. Be fearful when others are greedy, and greedy only when others are fearful. And right now, believe me, the market is very fearful when it comes to UnitedHealth. And if you want to see what that fear looks like in numbers, here it is. All that bad news absolutely crushed the stock. Year to date, shares were down a whopping 46%. Now, for a value investor, that doesn't scream crisis, it screams sale. So let's just put these two viewpoints side by side. The rest of the market looks at UnitedHealth and sees chaos, federal investigations, and uncertainty. But someone like Buffett, he looks at the exact same set of facts and sees something totally different. He sees an opportunity to buy the undisputed leader in its industry at a 46% discount. He's not focused on the next 3 months. He's focused on the next 10 years. So, when you zoom out from just this one stock, this whole filing teaches a really powerful, timeless lesson for anybody who's trying to invest their own money. You can really break his whole playbook down into 3 simple steps. Step 1, find a fantastic company. Step 2, wait. Just wait patiently for that great company to hit a rough patch that scares everybody else away. And step 3, when the price is right because of that fear, you pounce, and you pounce with conviction. And this is the key takeaway of the whole thing.
Buffett didn't invest in a troubled stock. He invested in a great business that was temporarily troubled. He bought it because of the short-term problems, not in spite of them. That's what created the bargain in the first place.
And that really leaves us with one last question to chew on. This move seems to prove that in investing, and maybe in a lot of other things, the biggest opportunities don't show up when everything is sunny. They show up when things look like they absolutely couldn't get any worse.